It wasn't a failure of military strategy. It wasn't a sudden lack of resources. It wasn't even the incompetence of kings or presidents. It was the mathematics of leverage. The collapse of history's greatest empires always begins in the counting house. It begins when the Asaj ledger no longer balances. It begins when the promise to pay exceeds the ability to produce. We look at history and see battles. We see treaties. We see elections. But these are merely the symptoms. The disease is always financial. The pattern is unmistakable. The arithmetic is merciless. Throughout history, the men who control the flow of money have held the true reins of power. They rise on a wave of productive growth. They consolidate power through debt. They capture the political machinery to protect their assets. And then, without exception, they overreach. The debt becomes unpayable. The currency is debased to cover the gap, and the society fractures under the weight of inflation and inequality. This is not a theory. This is the mechanical engine of history. We are told that modern finance is sophisticated. We are told that we have learned from the past. We are told that this time is different. But the incentives have not changed. The human behavior has not changed, and the math certainly has not changed. To understand where we are going, we must look at where we have been. We must look at the specific mechanisms that built the greatest banking dynasties the world has ever seen. And we must look with unflinching clarity at the specific mechanisms that destroyed them. The story is always the same. First comes the golden age of sound money and industry. Then comes the age of imperial expansion and military overreach. Then comes the age of debt. And finally, the age of debasement. We are going to examine 3 specific historical case studies. We will look at the banking crisis that shattered the Spanish Empire. We will look at the decline of the British pound and the City of London. We will look at the catastrophic failure of the German central bank in the 1920s. And then we will map this exact 7-stage pattern onto the present day. The warning signs are flashing. The data is screaming. The history books are open, but very few are reading them. Most observers agree that the seeds of the Spanish Empire as financial destruction were sown long before the actual collapse, rooted in the seductive relationship between the crown and the banking dynasties of Augsburg and Genoa. To understand the scale of this relationship, one must look at the reign of Charles V in the 16th century. This was a period that appeared on the surface to be an era of unparalleled prosperity and dominance. The Spanish infantry was the most feared military force in Europe. The fleets were bringing back literal mountains of silver from the Americas, specifically from the mines of Potosi in modern-day Bolivia. The data from the House of Trade in Seville records that between 1503 and 1660 roughly 185,000 kilograms of gold and 16 million kilograms of silver entered. Spain, by all conventional logic, Spain should have been the wealthiest nation on earth and its bankers the most secure, but the reality was a hollow shell built on leverage. The incentive for the crown was perpetual wars against France, wars against the Ottomans, wars against the Protestants in the Netherlands. These conflicts required immediate liquidity. Soldiers needed to be paid in gold, not in promises, and they needed to be paid today. The silver from the Americas, however, arrived only periodically. With the treasure fleets, there was a timing mismatch. To bridge this gap, the Spanish crown turned to the great banking families, most notably the Fuggers and the Welsers of Germany, and later the Genoese banking families. The mechanism was the asinto, a short-term loan contract with high interest rates often secured against future silver shipments. The bankers, driven by the desire for yield and political influence, lent vast sums to the emperor. At first the arrangement worked. The silver arrived, the bankers were paid with interest, and the credit flowed. But the arithmetic of compound interest is faster than the extraction of silver. By the mid-16th century, the crown's debt service payments were consuming the majority of the states as revenue. Consider the specific figures from the year 1556. When Philip II ascended the throne, he inherited a debt of approximately 20 million ducats. The annual interest on this debt alone was greater than the crown's entire yearly revenue. The incentive for the bankers to keep lending was the belief that the sovereign could not default, that the silver of the Indies was an infinite collateral. This was the fatal error. The bankers had become so entangled with the state that they could not cut off funding without triggering the very collapse. They feared they were trapped in a cycle of extend and pretend, rolling over old debts into new larger loans at even higher rates. The crisis point arrived in 1557. The treasure fleet was delayed. The wars in the Low Countries were draining the treasury at a rate of tens of thousands of ducats per month. The crown simply had no metal to pay the soldiers. On a specific day in that year, Philip II issued a decree that shattered the financial world. It was the first sovereign default of a global superpower. He converted the high-interest short-term agentos into juros, which were long-term low-interest government bonds. Think about what that means for the banker. The banker had lent gold, expecting a return of 10 or 12% in hard currency. Instead, he was handed a piece of paper promising 5% payable at some indefinite future date in a currency that was being debased. The Fugger dynasty, once the richest family in Europe, was effectively gutted. They had mistaken political power for solvency. They assumed that because they bankrolled the emperor, they were immune to the laws of mathematics. But when the liquidity dried up, the emperor chose to save his army and sacrifice his bankers. The fallout was not limited to the elites. The default of 1557 triggered a cascade of failures across the European economy. The price revolution, as historians call it, was already underway, driven by the influx of silver, which acted as a monetary expansion. Prices for basic goods in Spain skyrocketed. A fanega of wheat, which had cost a few hundred maravedis in the early 1500s, multiplied in price. The average Spanish laborer saw his wages stagnate, while the cost of bread and housing soared. The middle class was hollowed out. Land and noble titles became the only safe assets, leading to a flight of capital away from productive commerce and into passive rent-seeking. The industrious merchant class was priced out of existence, replaced by a society of impoverished peasants and tax-exempt aristocrats. The banking families of Genoa stepped in to replace the Germans, only to suffer the same fate in subsequent defaults in 1575. 1596, 1607, 1627, and 1647. The pattern repeated 6 times in a century. Each time the bankers believed this time is different. Each time the state chose inflation and default over austerity. Just like the Spanish Empire, the British Empire in the 20th century found itself trapped by the costs of global hegemony and the shifting sands of global finance. The decline of the British pound and the City of London offers a second chilling case study in how banking dominance is lost. For the century prior to 1914, London was the undisputed center of the financial universe. The gold standard was for all intents and purposes a sterling standard. A bill of exchange drawn on a London bank was treated as good as gold in every port from Shanghai to Buenos Aires. The Bank of England, operating from Threadneedle Street, acted as the conductor of the global orchestra, raising and lowering interest rates to maintain equilibrium. The turning point was the First World War. To finance the conflict, Britain was forced to liquidate its overseas assets. The creditor became the debtor. By 1918, Britain owed vast sums to the United States. The physical gold had flowed across the Atlantic, yet the banking elite in the City of London, led by the Bank of England, Governor Montagu Norman, were desperate to restore the pre-war order. They wanted to turn back the clock. They believed that the credibility of the British banking system depended on returning the pound to its pre-war parity of $486 against the U.S. dollar. This decision, made in 1925, was a triumph of dogma over arithmetic. The British economy had changed. The price level had risen. To return to $486 required a massive internal deflation. It meant forcing down wages, forcing down prices, and inducing a recession to prop up the currency. The incentive for the bankers was to preserve the value of the bond markets and the international prestige of the city, but the cost was paid by the coal miners, the shipyard workers, and the industrial base of northern England. The tension broke in 1931. The global financial crisis, triggered by the crash of 1929 and the failure of the Credit Bank in Austria, put unbearable pressure on the pound. Foreign central banks and investors began to doubt Britain's ability to maintain the gold standard. They began to withdraw their gold from the Bank of England. The drain was relentless. In July 1931, the Bank of England was losing millions of pounds in gold per day. The bankers pleaded for loans from France and the United States to defend the peg. They imposed austerity measures that triggered a mutiny in the Royal Navy at Invergordon, a shock that sent a signal to the world that the British state was losing control of its own instruments of power. On September 19, 1931, the Bank of England advised the British government that it could no longer defend the currency. The next day, Britain suspended the gold standard. The pound plummeted. The safe asset that bankers around the world had held as a reserve suddenly lost a quarter of its value. Overnight, the City of London's dominance was effectively overceded to New York. The holders of sterling assets were wiped out in real terms. The lesson here is critical. The banking elite sacrificed the domestic economy for years to protect the currency, but in the end, the mathematical pressure of debt and trade imbalances forced a collapse anyway. The middle class who had saved in pounds believing in the safe nature of British banks saw their purchasing power evaporate. The flight to real assets began in earnest. But for many, it was too late. Just like the British Empire, the Weimar Republic in Germany demonstrates the final most terrifying phase of this pattern, the total destruction of the currency by the central bank itself. This is not a story of a slow decline, but of a rapid chaotic disintegration orchestrated by the very institution tasked with stability. The Reichsbank, the figure at the center of this tragedy, was Rudolf Havenstein. The president of the Reichsbank, Havenstein, was not a revolutionary. He was a conservative bureaucrat, a man of the establishment, yet he presided over the greatest hyperinflation in history. The context was the crushing weight of war reparations imposed by the Treaty of Versailles. Germany was required to pay 132 billion gold marks. The state did not have the gold. It did not have the foreign currency. It had a shattered tax base and a fragile political order. The incentive structure for the Reichsbank was perverse. The government needed to pay workers, specifically the passive resistance workers in the Ruhr, who were striking against the French occupation. The government also needed to subsidize industrial cartels to keep the economy moving. Havenstein believed that it was his duty to provide the liquidity the state demanded. He did not see himself as destroying the currency. He saw himself as keeping the state alive. The mechanism was simple. The government issued treasury bills and the Reichsbank discounted them, effectively printing new marks to buy government debt. In 1921, a dollar was worth roughly 60 marks. By late 1922, the printing presses were running 24 hours a day. The Reichsbank even hired private printing firms to help meet the demand for paper notes. They could not print the money fast enough to keep up with the rising prices. By November 1923, the exchange rate was 42 trillion marks to the dollar. But these numbers are abstract. To understand the reality, one must look at the daily life of the German people. A cup of coffee ordered at 5,000 marks might cost 8,000 marks by the time the bill arrived. Workers demanded to be paid twice a day so they could rush to the shops during their lunch break to buy anything bread, cold soap before the prices rose again in the afternoon. The flight from currency was absolute. The banking system ceased to function in any traditional sense. Savings accounts were wiped out. A lifetime of savings for a middle-class family, perhaps 50,000 marks, which in 1918 could have bought a comfortable house by 1923, could not buy a loaf of bread. The creditors were annihilated. The debtors, however, were liberated. Industrialists who had borrowed heavily to buy hard assets, factories, mines, land, paid off their debts with worthless paper. The banking families who had held government bonds were ruined. The middle class, the teachers, the civil servants, the pensioners, were destitute. The psychological shock was profound. The German people lost faith in the structure of society. They had followed the rules, saved their money, and trusted the institutions. The institutions betrayed them. This betrayal created a vacuum of authority that was eventually filled by extremism. The collapse of the currency was the direct precursor to the collapse of the social order. It was not an accident of nature. It was a policy choice. When faced with the choice between immediate pain austerity and default or deferred pain inflation, the banking and political authorities chose inflation. They bought time, but they paid for it with the soul of the nation. The pattern repeats in 7 distinct stages. Stage 1 is sound money. The nation has a currency backed by a tangible asset or a robust production base. There is low debt and high trust. The banking sector is a utility facilitating trade rather than dominating it. Stage 2 is expansion and overconfidence. The nation grows wealthy. It expands its sphere of influence. It begins to engage in costly foreign entanglements or ambitious domestic programs. The banking sector grows in power and political influence. Stage 3 is the pivot. The costs of expansion exceed the revenue. The government and the banks begin to collaborate to bridge the gap. They introduce innovations in finance, fractional reserves, off-balance sheet vehicles, or suspension of convertibility. Debt begins to rise faster than GDP. Stage 4 is inflation and debasement. The debt burden becomes noticeable. To service it, the monetary authority suppresses interest rates and expands the money supply. Prices begin to creep up. The authorities blame supply chains or greedy speculators, but the cause is monetary. Real wages stagnate. Stage 5 is the crack-up boom. This is the flight into assets. The smart money realizes the currency is losing value. They borrow cheaply to buy land, housing, art, gold, and equities. The stock market may reach all-time highs even as the economy falters. The wealth gap explodes. The middle class is priced out of ownership. Stage 6 is social fracture. The inequality becomes politically unsustainable. Populism rises. There are calls for wealth confiscation, price controls, and capital controls. The social contract breaks down. The banks are viewed as parasites. Stage 7 is the reset. The system can no longer be sustained. A deflationary collapse occurs, or a hyperinflationary blow-off. The currency is either redenominated, pegged to a new anchor, or replaced entirely. Debts are restructured, often at the expense of savers. Just like in Rome, just like in Spain, and just like in Weimar Germany, we are currently moving through these stages with alarming precision. Current data suggest we are deep into Stage 5 and entering Stage 6. Consider the parallels. The United States and the developed West have enjoyed a period of global dominance underpinned by the U.S. dollar's status as the world reserve currency. This was our Stage 1 and 2. But since the late 20th century, and accelerating dramatically after 2008, we have entered the pivot. The debt-to-GDP ratios of major economies have surpassed levels seen during World War II. The response from modern central banks, the Federal Reserve, the ECB, the Bank of Japan, has been identical to the response of the Reichsbank or the Bank of England in the 1930s. Print money to fill the gap. They call it quantitative easing. They call it yield curve control. But the mechanism is the same: the monetization of sovereign debt. We see the symptoms of Stage 5 everywhere. The everything bubble is the modern equivalent of the flight to assets. Housing prices in major cities have decoupled from local wages, just as they did in 16th century. Spain's stock markets hit record highs, while the real economy struggles with supply shocks and labor participation issues. The smart money, the hedge funds, the family offices, the modern banking dynasties are positioning themselves in hard assets. They are buying farmland. They are buying single-family rental portfolios. They are buying gold. Here's the key. The incentive for the central banks today is exactly the same as it was for Rudolf Havenstein. They can not raise rates significantly without bankrupting the government and crashing the asset markets. The interest expense on U.S. federal debt is now one of the largest line items in the budget, rivaling the defense budget. If rates stay high, the math doesn't work. If rates are cut while inflation is sticky, the currency is debased. They are trapped. Counter-argument is often made. that we owe the debt to ourselves, or that modern technology is deflationary economic historians. Note that while technology does lower costs, it does not negate the effects of monetary expansion on asset prices. And regarding the debt, the holders of the debt are pension funds, insurance companies, and foreign nations. A default, whether explicit or through inflation, destroys the solvency of these institutions. The soft landing scenario assumes that the central planners can perfectly manage a deleveraging. That has never been successfully managed in history without pain. Under these constraints, the rational move for the authorities is financial repression. This is a subtle form of default. Involves keeping interest rates below the rate of inflation for a sustained period. This transfers wealth from savers, who lose purchasing power, to debtors, the government. It is a slow-motion confiscation. We are already seeing the early signs of stage 6 social unrest, polarization, and a growing distrust of institutions. The bankers are once again the target of public ire, yet the system is more dependent on them than ever. The endgame approaches in one of three ways. First is controlled decline. This is the path of financial repression. The currency loses 5% to 10% of its purchasing power every year for a decade. The middle class is slowly boiled like the proverbial frog. Standards of living decline, but nominal asset prices stay high. This mirrors the post-World War II period in Britain, where the empire was liquidated and austerity was the norm for a generation. The second path is chaotic collapse. This occurs if a shock hits the system that the central banks cannot print their way out of, perhaps a geopolitical crisis, a major commodity shock, or a sudden loss of confidence in the bond market. Yields spike uncontrollably. The central bank is forced to buy everything, leading to a currency crisis, similar to Weimar or modern-day Venezuela. The third path is reset and restructure. This is the Bretton Woods moment. The global powers convene to establish a new monetary architecture. This could involve a return to a commodity anchor, or more likely, the introduction of central bank digital currencies, CBDCs, that allow for total control over the velocity and distribution of money. This mirrors the 1931 shift or the 1971 closing of the gold window. It is a rewriting of the rules to save the system at the expense of the current holders of currency. History shows us that the transition is rarely smooth. In 1933, the U.S. government confiscated gold from its citizens to facilitate a revaluation. In 2013, Cyprus bank deposits were bailed in to recapitalize failed institutions. The precedent for radical action exists. The only variable is timing and pain. We cannot predict the exact day the bond market breaks. We cannot predict the exact trigger, but we can see the structural stress. The most powerful banking families in history, the Fuggers, the Barings, the merchant princes of Genoa, all believed they were too big to fail and too close to the seat of power to be touched. They were wrong. The cycle turned, and they were crushed by the very debts they helped create. The prudent course of action is not to speculate on the timing, but to prepare. For the inevitable structural shift, it requires education. It requires understanding that money in a bank is a loan to that bank, not a risk-free asset. It requires resilience in your personal supply chain and your skill set. It requires paying attention to the data, not the headlines. The history of finance is a history of illusions being shattered by arithmetic. Do not be the one holding the illusion when the music stops. Subscribe to continue this analysis.